I'm Josh Landau, president of the International Insurance Society. I'm excited to introduce our next webinar featuring one of our key global partners, BlackRock, leading today's discussion to explore what is at the leading edge of analytics for sustainability. Noting the work BlackRock has done through the launch of Aladdin Climate is Sam Tortora, managing director and global head of Aladdin Sustainability at BlackRock. She's responsible for leading the development, delivery, and the use of sustainability data, analytics, and tools for BlackRock and its clients across both climate and ESG. Welcome, Sam.
Thank you, Josh, and thanks to all of you for taking the time today to gain some additional perspective on the evolution of sustainability data and analytics. I'm Sam Tortora, and as Josh mentioned, I'm the global head of Aladdin Sustainability at BlackRock, where we're building technology to help BlackRock and our clients navigate investing in a world where sustainability factors are having an even greater and more measurable impact on financial outcomes. Prior to taking on this role a few months ago, I led investor relations and corporate sustainability for BlackRock, where I was very focused on integrating sustainability into our strategy and our operations, as well as working through which ESG metrics to track and disclose based on their importance to stakeholders. I'm speaking to you today at the nexus of both that inside-out view of sustainability data from the perspective of a company and the outside-in view from the perspective of a sustainability analytics and technology platform that's aggregating data and information across companies to help investors understand the impact and relevance of this information on portfolio outcomes. For the next 15 minutes, I'm excited to talk through what's on the leading edge of climate analytics, the evolution of ESG data, and how we're delivering both in Aladdin to help investors build and manage portfolios as sustainable investing becomes a standard for managing assets. So let's start with a bit of context on why the financial services sector cares so much about understanding climate change. A growing number of governments, business leaders, and financial institutions have been coalescing around a consensus to achieve net zero emissions in the global economy by 2050. And these commitments accelerated even more after the recent COP26 conference. What this means is that collectively, by the year 2050, we would emit no more carbon dioxide than we remove from the atmosphere. If the world enacts associated policies and invents and adopts the technology needed to successfully transition to a net zero economy, BlackRock's capital markets assumptions estimate a 25% cumulative gain in global GDP by 2040 as compared to the business as usual scenario. Achieving net zero by 2050 is no small feat though. It will require a wholesale change to the way we produce things, grow food, move goods, use energy, transport people. Essentially, it will change the way we live today. With this transformation, there are both meaningful investment risks and opportunities that will emerge. And for investors to be able to mitigate these risks and capture these opportunities, they need to be able to measure the financial impacts associated with climate change. This is really hard to do, partly because there are gaps in the data that's tracked and collected, and also because we can't precisely predict the future. Until fairly recently, there was a lack of urgency and consistency in the reporting of climate data, and also a lack of attention on it by the financial services sector. However, over the past few years, the urgency to address climate change has become more apparent through an increase in the frequency of extreme weather events and the many public commitments to reach net zero. That, plus rising stakeholder demand, better technology, and heightened regulation have led to significant advancements in the availability of climate data. Stakeholders are asking for information on how companies are adapting their strategies to mitigate climate-related risks and transition to a low-carbon economy. Rapid advancements in artificial intelligence and machine learning have led to massive enhancements in both the research and modeling that underpins climate analytics. And more companies and financial institutions are reporting to environmental frameworks like TCFD and CDP, which is driving greater transparency into data like greenhouse gas emissions at the company level and the emissions targets that companies set over time. As financial institutions, we need to collect, process, and analyze these and other data points in order to measure the impact of climate change on investment portfolios. There are two key types of risks we're trying to measure: physical risk, transition risk. The physical risk of climate change is really a measure of the change in frequency of extreme weather events due to a rise in global temperatures and the impact of those events on the financials of a company. While there's no single approach to measuring the physical climate risk of an asset, it involves collecting data on climate perils like hurricanes, wind, and the rise in temperatures at a hyper-localized level. It also involves converting these risks into economic impact and investment risk, and ultimately translating investment risk into financial terms. The ability to measure these risks involves layering data on top of data and models on top of models. And we're fortunate that there's more climate data available than ever before to help us build analytics and generate meaningful insights. Transition risk represents the changes that result from society's transition to a lower carbon world. That means new policy, new technology, emerging renewable energy sources, changes to global supply chains. And while we don't know exactly how these changes will play out over the course of the next several decades, organizations like the Network for Greening the Financial System, or commonly known as NGFS, and the Intergovernmental Panel on Climate Change, commonly known as IPCC, have developed scenarios which allow us to explore possible futures, the assumptions they depend on, and the courses of action that could bring them to life. So what do these potential futures look like? On one end of the spectrum, we're unable to effectively transition to net zero by 2050 and experience severe physical damage, coupled with eroding GDP, health, productivity, and jobs. On the other end of the spectrum, the outcome is one in which we successfully transition to net zero, following a profound and intentional restructuring of the global economy. This includes entirely new industries, companies, policies, technologies, and just ways of operating. Both of these and the infinite scenarios in between imply dramatic changes to the economy and have significant implications for investment portfolios. Because we haven't yet invented a technology that will actually enable us to predict which scenario will occur, investors need to understand their exposure to transition risk under different scenarios. Additionally, to help make climate analytics more precise, we have an urgent need for more granular and real-time carbon emissions data at a hyper-localized level and at scale. Today, emissions data is typically self-reported to CDP on an annual basis by companies. If you think about corporates setting targets and tracking progress towards those targets, more timely data and at an increased frequency is critical for us to actually measure how they're evolving their strategies and actually adapting them to exist in a net zero world. That's why we ultimately need carbon emissions data in real time. Academics, climate scientists, and researchers have done a remarkable job providing emissions data more efficiently than we ever thought was possible using AI and machine learning. But there's still a lot more work to be done, and we're excited to be a part of that work. In addition to climate, there's a much broader component of sustainability, one that encompasses additional environmental, social, and governance factors. ESG. This ESG data aims to quantify a company or security's exposure to and management of ESG issues, risks, and opportunities. Similar to the recent proliferation of climate data, there's been an explosion of ESG data in the world, driven in large part by stakeholder demand for increased transparency. Clients, shareholders, communities, and employees want more information than ever before about the products they buy and the companies they work for and support. And asset management is no exception. While historically, transparency simply meant quarterly and annual reporting of financial results, it's now no longer just about financial metrics. Stakeholders want to know things like, how is your company instilling and maintaining its culture? How are you contributing to the communities in which you operate? How are you diversifying your employee base and board of directors? And these demands have led to a massive shift in the way companies provide data, from sustainability frameworks like Sustainability Accounting Standards Board to third-party questionnaires and assessments to the integration of sustainability data and information into annual reports and proxy statements. Companies are providing more information on ESG to their stakeholders than ever before. This data is collected by firms like MSI, Sustainalytics, Refinitiv, S&P, ISS, and analyzed to generate scores, ratings, benchmarks, and data sets for companies to consume. And there are many, many emerging ESG data aggregators and providers in the market. My perspective is that there's no one perfect ESG data provider. And down the line, it will take individual fundamental investment teams looking at multiple sources of data side by side to gain perspective and take a view on how a company might perform based on different pieces of information, and also unstructured sources of data where they can glean sustainability insights. Advancements in technology have facilitated a new way of collecting sustainability data on companies. Unstructured data like social media posts, event transcripts, and audio files is growing at an exponential rate. While historically, we really haven't had the technology to process this data, today we have a number of analytical tools powered by artificial intelligence to help us process and derive insights from unstructured data. While the application of artificial intelligence to collect sustainability data and measure performance is largely new, we believe it can play a key role in things like new product development, improving efficiency measures, closing gaps, and helping companies reduce their environmental footprint. Despite greater transparency and better technology, ESG data is not perfect. There are still so many challenges in actually measuring the social component of ESG, or the S in ESG. In recent years, companies have made a lot of progress on reporting qualitative social information, like information on the diversity, equity, and inclusion initiatives and human capital management, but we still struggle to quantify the impact of these metrics on financial performance. Part of the reason for this is regional nuances, but it's also the lack of standard reporting system for presenting data on social issues to investors. This makes it very challenging to properly assess social factors in the context of investment and risk management, but it's an area that we're very focused on moving forward. Another area that needs to be addressed is the regulation of private companies. Because private companies are not held to the same level of scrutiny as public companies, we've created an unintended incentive to shift unsustainable assets to markets with less transparency and often less regulation. While divesting from these unsustainable assets may make public companies look better in the public eye, it will do nothing to advance us towards a more sustainable world. We need public markets and public assets and private assets to have the same standards of reporting on sustainability information. At BlackRock, we've always viewed asset management as an information processing business. That's why we built Aladdin, to make complex investment data more transparent and actionable for BlackRock and our clients. BlackRock was founded in 1988 because our founders saw a gap in the asset management industry. Institutional investment managers had primarily been focused on generating returns for their clients, but without a focus on clearly understanding and managing the risks associated with those investments. In order to build an asset management firm with a focus on risk management at its core, they needed models, analytics, and technology to process this information. So they built it themselves. Aladdin became the enterprise investment and risk management platform used to manage our clients' assets from our very first days. And as we grew and evolved as an asset management firm, spanning every asset class from fixed income to equities, multi-asset, and alternatives, across active and index strategies, our Aladdin technology also evolved to support and scale the growth and evolution of our business. Today, we're very focused on understanding and managing sustainability risks and opportunities, like climate change, using Aladdin, because they materially affect clients' portfolios. The successful navigation of these risks is linked to our fiduciary duty to our clients and our purpose of helping more and more people experience well-being. The recent explosion of climate and ESG data adds a whole new set of information for us to process and deliver alongside financial information. And that's why we started the journey to build Aladdin Climate. The goal of Aladdin Climate is to translate climate risks and opportunities into investment terms so that investors can understand their exposure to financial risks associated with climate change and take action across portfolios that are managed on behalf of the millions of people they serve. It also allows them to report to the various regulatory bodies and sustainability frameworks that their stakeholders are asking for. We're looking to enable investors to answer questions like, how could rising sea levels affect my mortgage-backed security portfolio? Or how would BP fare versus Exxon in a rapid shift to an aggressive carbon tax policy? So we've spent some time earlier talking about physical risk and transition risk. And in Aladdin, we've built out capabilities to look at both. But we've also built out capabilities to show investors how their investments are also impacting the changing climate, temperature alignment metrics. Let me spend a couple of minutes explaining how each of these analytics work. Aladdin Climate's physical risk analytics quantify the impact of extreme weather events and physical changes in regions around the world on assets, issuers, investments. We acquired a set of physical climate risk models from the Rhodium Group, which gave us access to information on a bunch of different physical risks, like rising temperature, changing precipitation, tropical cyclones, and coastal flooding at this hyper-localized level. The models then connect these physical risks to their associated economic impact, related to changes in energy costs and labor costs, for example. And to make this information useful for investors, we translate these economic hazards into investment risks and ultimately to the valuation of securities and whole portfolios. Aladdin Climate's transition risk analytics help quantify risks and opportunities arising from exposure to the transition to a lower carbon economy. Earlier in 2021, we acquired the climate change scenario model from Baringa Partners, which, in combination with Aladdin's financial models, enables us to deliver analytics on the effects of different transition scenarios on different sectors, like oil, gas, and utilities. This sector-specific impact enables us to do more granular modeling of how the transition to a lower carbon economy affects assets, companies, and portfolios. The third way climate analytics show up in Aladdin Climate is temperature alignment. This shows the potential global temperature rise associated with greenhouse gas emissions from a given company. In other words, we're showing the type of future an asset is tracking towards. Roughly 70% of global GDP and emissions are covered by a net zero commitment today. And in line with these pledges, more and more organizations are seeking to build portfolios that are aligned to the Paris Climate Agreement or specific temperature rises compared to pre-industrial levels. Aladdin Climate takes the temperature alignment of individual securities and aggregates it up to the portfolio level so that investors can see the temperature rise their portfolios are tracking towards. This is the first time climate metrics are being looked at alongside more traditional financial risk metrics. We know it's going to take time to build confidence in these analytics, and we're on a mission to collect and incorporate as much relevant data as possible as inputs to our models so that we can build more precise models and analytics and power more informed decision-making. Outside of Aladdin Climate, but integrated across the Aladdin platform, we're designing tools and mechanisms for analyzing other relevant ESG information at the security, company, and portfolio levels. Having previously led BlackRock's corporate sustainability function, we were very focused on understanding which ESG metrics were actually important to our company's long-term performance, and then disclosing that information to our stakeholders. In Aladdin Sustainability, we're pulling information that companies disclose alongside other third-party and unstructured data sources to provide better insight for investors into a company or security or assets ESG profile and impact. We've integrated a robust range of ESG data and metrics from third parties, and this includes headline ESG scores at the top of the house company level to metrics and templates that support regulatory disclosures such as SFDR and EU taxonomy. Integrating the abundance of climate and ESG data into investment frameworks is an evolving process, and there's no one right answer to how investors should do this. What we're doing in Aladdin is bringing together multiple sources of information so that investors can understand and act on sustainability risks and opportunities, regardless of what stage they're at in their sustainable investing journeys. Whether you're a stewardship professional engaging a company's management team, a portfolio manager building an impact strategy, or a risk manager assessing portfolio risk, sustainability data plays an important role in enabling you to achieve the best possible outcomes for your clients. I'm so excited for the progress that we've made so far in Aladdin sustainability and the many opportunities that we have ahead of us as we continue to build our sustainability data, analytics, and technology platform that serves a world where sustainable investing is the standard. Thanks so much for your time today.